green for Halloween. Futures near the highs of the morning right now. As we watch earnings, GM is out this morning, a double beat there. Company reported better than expected earnings at $1.87 a share and revenue of $35.79 billion. Facebook reported disappointing revenue and user growth, as you heard, and Apple is having its results tomorrow. Apple is expected to report strong numbers, and there's the Facebook earnings at $1.76 on $13.73 billion. Here to discuss earnings in general and the backdrop for investing is CFRA Research Chief Investment Strategist Sam Stovall. Sam, good to see you.
Good to see you, Maria.
So assess the earnings story for us so far. How's it looking so far?
Actually, a lot better than you would anticipate. With the market having declined as much as it did, you would think that we'd be cutting earnings estimates for Q3, but actually 9 of the 11 sectors in the S&P 500 have seen their earnings estimates increase. Instead of being around 21.5% growth, we're now looking for about 25% growth in the third quarter.
Wow, 25% profit growth.
Exactly.
That's good.
But the question about an earnings peak is still out there, because take a look at full year 2019 estimates, and the reverse is true. 9 of 11 have seen their earnings estimates come down. So what was about a 10% earnings growth is now estimated about 9.3%.
What about revenue? Because Dagan's been mentioning that a number of companies have been low on revenue or weaker than expected on revenue.
Right. Well, revenues are expected to be up about 8.9% for this year.
This year or
this year? Well, and this quarter about 8.7%.
Okay.
So the revenue growth is still sort of hanging in there, but for 2019, revenue growth is expected to be around 6%.
And 43% of companies have missed on the revenue expectations. 43%. Compare that to 18% in the same period in the last quarter. So again, you get this earnings growth because of the tax cut, the benefit there to corporations, because of cost, because of share buybacks, because of cost cutting. But at the end of the day, you got to grow your revenue, and the revenue growth is slowing into next year, as you pointed out. That's one of the reasons the market's been so rattled.
Well, I think it's one of the reasons. I'm saying that the market is worried about PEs, politics and earnings. So the politics in terms, obviously, of the China trade situation, politics in terms of midterm elections. Also, you can throw in there the Fed, even though they're supposed to be independent from politics. Obviously, with the president making statements about his displeasure with the direction of interest rates, that sort of adds to it all. And then the earnings picture, because we are expected to be entering into a declining rate of growth, mainly because the comparisons are going to be even more challenging as we go into 2019, because the bar has been set so high. I think investors are saying, you know, they're repeating that Michelob commercial. It doesn't get any better than this.
So let me ask, so go through the numbers. So 2018 earnings and revenue are expected to be what for 18? And then give me 19.
For 18, earnings are expected to be up 24.8%.
Okay.
Revenues up 8.9%.
Okay.
And then for 2019, earnings right now expected to be up 9.3%, and revenues up 6%.
But then that goes back to what multiple does it trade at? Below 16, 17? We've got a rising interest rate environment. So what can investors expect, right? So for next year, this year we're down on the year, we could say, or we could end up slightly above where we're at, maybe 2,700, maybe 2,800 on the S&P 500. But next year, what should I be anticipating in equity returns?
I think that what's happening right now is we are seeing an adjustment of that acceleration, readjusting our expectations for the year ahead. You're absolutely right that if earnings or growth is going to be coming down, then you want to be less optimistic. The price to earnings multiple should be coming down. Right now, we're looking at about 15.8 times coming 12-month earnings. The average is 16.4. The median is about where we are right now. So the question then comes down to, have we adjusted 2019 earnings enough? Do they need to come down even more? So I would tend to say that that's the jockeying that will be taking place over the next several months, is people to say, well, how much will we be seeing truly in growth next year, or how much do we need to cut?
Sam, you mentioned how much politics is having an effect on the markets. I'm curious, we have elections, of course, next week in the U.S., but we also saw elections in Brazil with another populist leader. We also saw elections elections in Germany over the weekend, in which Angela Merkel's party lost so much power that she said she's not running for re-election. Huge changes in Europe, especially as we come to the end of the Brexit negotiations. Outside of the U.S., how much of these geopolitical disruptions do you see continuing to affect our markets?
Maybe less affecting our markets, but continuing to affect their markets. I mean, when it comes to political change, you can only think of one word: uncertainty. And that's typically why we end up with the second and third quarters of midterm election years posting average declines in price. We didn't get that this year. This is the first time since World War II that we had all 6 of those months in positive territory, so we ended up getting it all in October.
I've raised the issue that one of the, concern about the midterms is the reason that the market sold off in the month of October. However, if investors were really concerned about kind of the left-leaning raise your taxes policies being put into place, you would have seen the market really sell off during the summer, when the Democrats certainly had more of an edge in the House and more of an edge overall than the Republicans did, because it was the Brett Kavanaugh hearings in the month of September that really turned the tide for the Republicans. And then you had the stock market sell off. That wouldn't make sense logically. So there's something else afoot here.
The dollar, maybe?
Yeah.
Yeah,
I mean, think about that. I mean, the dollar's up 9% since its February low, and it's impacting company after company. Talk about Clorox this morning. They're down 5% because they're talking about cost pressures and how FX is going to impact their sales into the overseas markets. Do you see the dollar as the overhang, or is it the political environment?
No, I think it has more to do with global trade, the dollar overhang, more of the total uncertainty, because people are well versed in what typically happens before midterm elections and then what typically happens after. 18 of 18 years, the market was higher 12 months later. So we've all been told that for quite some time. I think, however, that maybe the political scenario was an excuse, but I really think that the biggest uncertainty did come from the China trade issue, the stronger dollar, and what kind of forward pressure that would be on earnings.
Sam, it's good to see you.
Thank you so
much for all the great insights. Sam Stovall there.